Hello, everybody, and welcome back to another workshop. Today, I'm going to be talking about and discussing maximizing child and dependent care tax benefits, simple savings for busy families. So before we jump in, I'm going to go ahead and tell you guys a little bit about who we are. So we are the Taxpayers Help Center, which is a nonprofit organization in Northridge, California. We operate two tax clinics, one being our low-income taxpayer clinic, where we help taxpayers resolve their tax disputes with the IRS. And then secondly, our second service or clinic is going to be the Volunteer Income Tax Assistance VITA Clinic, where we help prepare income taxes for free. So Masu Shatoni, he is the CPA and the director for both clinics. And then myself, Amiel Duncan, I am the director of the outreach program for the Low Income Taxpayers Clinic. Now, how to support individuals and businesses can support us financially by donating funds to help us expand the reach of our services. They can volunteer their time or expertise or spread awareness about our services as well. Lastly, we help taxpayers both locally and beyond. We are an IRS authorized certifying acceptance agent, CAA, for the individual taxpayer identification numbers, also known as ITIN. So if you do need an ITIN application, you could go ahead and call us today or to set up an appointment to apply for an ITIN number. And then to stay connected with us, we are located at 9029 Reseda Boulevard, Suite 209, Northridge, California. Our telephone number is going to be 818-366-0111. Our website is www.taxpayershelpcenter.com. Email is info@taxpayershelpcenter.com. And lastly, if you feel that today's presentation was beneficial towards you and can be helpful to someone that you know or love, you can go ahead and send them to our Facebook page where we will upload this presentation later on. And then we do have previous presentations as well. So our Facebook is Taxpayers Help Center, Inc., a nonprofit tax organization. Now, let's go ahead and jump in. Maximizing child and dependent care tax benefits, simple savings for busy families. So what are child independent care tax benefits? Child independent care tax benefits are tax provisions that allow taxpayers to offset part of their expenses for care services. These benefits primarily help those who pay for childcare or dependent care so they can work or actively look for work. Eligible expenses might include daycare, babysitting, or care for an elderly or disabled dependent. Overview of the IRS Child Independent Care Credit. The IRS Child Independent Care Credit is a non-refundable credit that allows eligible taxpayers to claim a percentage of qualified care expenses. The credit amount varies based on income with a maximum of 35% of care expenses for lower income households. For the 2023 tax year, eligible expenses are capped at $3,000 for one dependent or $6,000 for two or more dependents. The credit can reduce your tax liability, directly lowering the amount you owe to the IRS. So the importance of knowing how to claim these benefits. So understanding how to claim these benefits is essential for taxpayers as it can significantly reduce the cost of necessary care expenses. Knowing eligibility requirements, qualified expenses, and income limits ensures that taxpayers can maximize their benefit. Properly claiming the child and dependent care credit can lower the total tax bill, freeing up resources for other family needs. So who qualifies for the credit? A qualifying person for the child and dependent care credit includes children under 13. So this could be your biological child, stepchild, foster child, or sibling, or a descendant of any of these, like a grandchild, as long as they're under the age of 13 at the end of the tax year. Then dependents who cannot care for themselves. So this could be any dependent who is physically or mentally incapable of self-care this includes elderly parents or relatives who rely on you for daily care due to disabilities. And then lastly, other dependents. So in some cases, other relatives who live with you and meet specific criteria may also qualify, provided that they cannot care for themselves and you meet the other requirements for the credit. Now for earned income requirements. So to qualify for the child and dependent care credit, both single taxpayers and couples filing jointly must meet the following earned income requirements. So earned income by definition includes wages, salaries, tips, professional fees, bonuses, and other amounts received for personal services. It also includes net earnings from self-employment. For single taxpayers, you must have earned income during the year to claim the credit. If you are single and have a qualifying child or dependent, your earned income must be greater than zero. And then couples filing jointly, both spouses must have earned income if they are married and filing jointly. If one spouse is a full-time student or incapable of self-care, only the other spouse's earned income is required. And then lastly, expectations. If you are a full-time student or incapable of self-care, you may still qualify even if you have little or no earned income provided by your spouse, or if your spouse has sufficient earned income. So special rules for married taxpayers filing separately and filing status requirements. So when it comes to married taxpayers filing separately, there are specific rules and important considerations. So once again, for married filing separately, you are ineligible if or ineligibility requires married couples who choose to file separately that are not eligible for the child independent care credit. This is because the IRS views the care expenses as joint responsibilities that should be claimed together. For filing status requirements, to claim the credit, you must file as single, head of household, qualifying widow or widower, or married filing jointly. For head of household, to qualify, you must pay more than half the cost of maintaining a home for a qualifying person and meet other IRS requirements. Importance of correct filing status. So choosing the correct filing status is crucial because it affects your eligibility for various tax credits, including the child independent care credit. Incorrect filing status can lead to disqualification from the credit or other tax benefits. And then lastly, additional considerations. If you are eligible to file as head of household, it may provide more tax benefits compared to filing as single. So you want to ensure that only one spouse claims the credit for the same care expenses to avoid duplication and potential IRS penalties. So examples of eligible expenses. This could be daycare and childcare providers. So costs for daycare or in-home care providers qualify as long as they incurred while you're working or seeking employment. Preschool and nursery schools. So fees for programs that provide care and early learning for children under school age are generally eligible. After-school programs and care for disabled dependents are also eligible expenses. So for after-school programs, if your child needs supervision after school, the cost for this care can qualify. And then for care for disabled dependents, care expenses for a dependent with a disability, regardless of age, are eligible as long as they care or as long as the care allows you to work. Now, examples of ineligible expenses. So education, costs for kindergarten or higher grades are ineligible as they're considered educational rather than care related. Overnight camps are also ineligible. Overnight camps expenses do not qualify as the IRS only permits claims for daytime care expenses. And then lastly, extracurricular lessons or tutoring. So if your child is in activities like music lessons, these are typically ineligible as they're educational and not directly related to work-related care needs. Now moving on to work-related expenses. So here are some real-life examples of work-related expenses. So the first one is daycare for a preschooler. Example is Sarah works full-time and enrolls her 3-year-old into a local daycare center during her work hours. The fees she pays to the daycare provider are considered work-related because this care is necessary for Sarah to perform her job. The second example is going to be after-school care for an older child. So the example goes, Michael works as a nurse with evening shifts, so he arranges for his 8-year-old child to attend an after-school program. The program fees qualify because this care enables Michael to continue working. And then we have 2 more examples. So in-home care for a disabled parent. Example is Lisa's elderly father who has a physical disability, lives with her and needs daily assistance. Lisa hires a caregiver to support him while she's at work. The cost of the caregiver qualifies because it allows Lisa to maintain her employment. And then the last example is going to be an example of something that's ineligible for the expenses and the credit. So this is going to be overnight camp. Emma's 2 children attend an overnight camp during the summer. Since this camp includes an overnight stay, the expenses are not eligible for the credit as only daytime care qualifies. Now, how much can you claim? Sliding scale for credit percentage. So the credit percentage is based on adjusted gross income, also known as your AGI. So 35% of expenses for taxpayers with an AGI of $15,000 or less. And then we have 20% of expenses for taxpayers with an AGI of $43,000 or less or above, excuse me. And then lastly, we have the gradual reduction for AGIs between $15,000 and $43,000. The percentage gradually decreases as income increases. Maximum limits for claiming expenses. The IRS sets maximum limits on the amount of expenses you can claim for this credit. So $3,000 for one qualifying person and $6,000 for 2 or more qualifying people. However, if you do receive dependent care benefits from your employer, such as through a flexible spending account, FSA, for dependent care, the eligible expense limit is reduced by the amount of those benefits. For example, if your employer provides $1,000 in dependent care benefits, your maximum claimable expenses would be reduced to $2,000 for one dependent or $5,000 for 2 dependents. And then listed below, I do have an example of the calculation of the credit based on income and expenses. So for the example, the income, a couple has an AGI of $35,000. Their care expenses they have incurred $4,000 and qualifying expenses for their two children. And then for the employer benefits, they received $500 in dependent care benefits from their employer. So to calculate this, step one, you're going to adjust the eligible expenses. So the original eligible expense limit is $6,000 for two children. And then you're going to subtract the employer benefits from that. So it'll be $6,000 minus 500, which would then give you $5,500 of eligible expenses. Step two, you're going to determine the applicable percentage. So with the AGI of $35,000, this couple qualifies for a credit rate of about 27% on the sliding scale. And then step three, you're going to calculate the credit. So with their eligible expenses being $5,500 from step one, the credit percentage is 27% from step two. You're going to multiply those two together. So $5,500 times 0.27, and that gets you $1,485. So this couple would ultimately receive a child and dependent care credit of $1,485, which directly reduces their tax liability dollar for dollar. Now, how to claim the credit. So to claim this credit, you're going to use Form 2441. This is to report child care or dependent care expenses, and this also will help you calculate the allowable credit and provide information on the care provider. So by filling out this form correctly, you can claim the maximum eligible credit, helping to reduce your tax liability. So if you can see listed to the side right here, I do have a picture of what the form does look like for the year of 2023. And you can always find this form on the IRS website. Now, step-by-step guide to completing Form 2441. So the first part is care provider information. So this is where you're going to enter the care provider's name, address, tax identification number, or their social security number, whichever one they have. And then you're going to provide this information for each care provider as the IRS requires it to verify the expenses. Without this, your credit may be denied. The second part for part two, which is right over here, you're going to calculate the credit. So this is where you do all of the mathematical stuff that we just went through in the example. So for part two, you're going to enter your qualifying expenses for each dependent and ensure that they don't exceed the maximum limits. Once again, it's $3,000 for one child, $6,000 for two or more. And then use the sliding scale based on your AGI to calculate the correct credit percentage, which Form 2441 will guide you through based on your AGI. And then part three is dependent care benefits, if applicable. So if you receive dependent care benefits from your employer, you are going to report them here. So this form will automatically adjust your maximum eligible expenses accordingly. Now, the importance of the care provider's tax ID or social security number. So the IRS requires the tax ID or social security number of each care provider to prevent fraud and verify the legitimacy of the claimed expenses. So if you can't provide this information, you do risk losing the credit. So be sure to request this information from your provider and to enter it accurately. Now, tips for maintaining records and supporting documentation to protect yourself in case of an IRS audit. So the first tip is going to be keeping your receipts. You want to make sure you collect all receipts for payments made to your care provider that shows the dates, amounts, and services provided. The second tip is going to be maintaining a detailed log, so recording the hours and days when care was provided and the costs associated with each. And then lastly, we have retain Form W-10. So if your provider is a business or a self-employed individual, they should go ahead and fill out Form W-10, which is the dependent care provider's identification and certification, which includes their name, address, and tax ID. So keeping thorough records ensures that if the IRS requests additional documentation, you're well prepared to substantiate your claims and retain your credit. And then one of the last things we're going to go ahead and discuss is common mistakes and how to avoid them. So the first common error that we see pretty frequently is going to be forgetting to include care provider details. So many taxpayers overlook providing the care provider's name, address, and tax ID or SSN on Form 2441. And the consequence of this is missing information can lead to a denial of the credit, and the IRS, or as the IRS requires it to validate the claim. The second most common error that we do see is not reducing expenses by employer benefits. So taxpayers sometimes fail to reduce their claimed expenses by the amount of dependent care benefits provided by their employer, such as funds from a dependent care FSA. And the consequence of this is that this oversight can result in claiming a higher credit than allowed, which may lead to an IRS correction or penalty for overstated expenses. And then the third most common error that we do see is claiming ineligible expenses. So accidentally including non-qualifying costs like overnight camps or kindergarten tuition, which don't count toward the credit. So the consequence of this is including ineligible expenses can reduce or invalidate the credit if audited. So once again, the potential consequences of these errors. So even a small mistake can affect your tax return. Incorrect or incomplete claims can lead to delays in processing, penalties, or loss of the credit. So errors can also increase your chance of an IRS audit, especially if the IRS notices patterns that don't align with the eligibility rules. Now, for best practices for ensuring compliance, maximizing your credit, you're going to, one, double check all provider details. So once again, you're going to gather all of the providers' tax IDs or SSN and confirm their address to ensure accuracy. And if you're using multiple providers, check that the details are correct for each one on Form 2441. And then second, you're going to adjust for employer provided benefits. So before completing your return, total any dependent care benefits received and deduct this from your eligible expenses. Be sure your final figure aligns with the IRS guidelines for maximum eligible expenses. The third tip that we have is going to be verifying eligible expenses only. So once again, you're going to review your expenses to confirm they're eligible for the credit. And you're also going to avoid including items like education or extracurricular fees. And then lastly, you're going to keep an organized record. So maintain a file of all receipts, invoices, and provider documentation to back up your claims in case of an audit. For employer benefits, retain any records provided by your HR department on the amount contributed. So by following these best practices and carefully reviewing Form 2441, you can reduce errors, increase your chances of receiving the full credit, and avoid any tax time surprises. So taking these extra steps ensures that all requirements are met for a smoother filing experience and peace of mind. And with that, that concludes today's workshop. So thank you everyone for your time. If you do have questions, you can stay back and ask, but if not, I'm going to go ahead and end this meeting. And then lastly, once again, stay connected with us. You can come visit us in office at 9029 Reseda Boulevard, Suite 209. Call us at 818-366-0111. Check out our website, which is taxpayershelpcenter.com, or you could go ahead and check out our previous workshops on our Facebook page, which is Taxpayers Help Center, Inc., a nonprofit tax organization. And with that, I want to thank everyone once again, and I hope you guys all have a good rest of your day. Bye.